All right, let's take a look at Perion. Question was curious to hear your take on the small cap tech stock. Despite consistent growth, it trades at a PE of 10 and momentum is ugly. What am I missing with this one? Thanks. This is from Noel via email. So Perion Network Limited trades under the symbol PERI on the NASDAQ, trading at about $12 per share, $600 million market cap, and 50 million shares outstanding. Perion's a technology company, essentially an ad tech company. They specialize in digital advertising and monetization solutions across multiple platforms like websites, search engines, and social media. What they do is they leverage advanced data analytics for audience targeting. So if you look at the company's share price performance over the past 5 years, fairly volatile the whole way along, but doing fairly well up until around May of 2023. Since then, we've seen a significant drop. And the viewer's question was right on point when with respect to the momentum, which is quite ugly. So the share price a year ago was up over $40 and trading today at about $12. Just recently, over the past couple weeks, big drop in the share price, losing about half of its value. So what's going on here with Perion? Now, if we look at the company's historic financial performance, for example, revenue, we see good, strong revenues, consistent growth in revenues over the past 6 years. Same can be said for normalized EPS, particularly over the past 3 years, very strong earnings growth, but consistent profitability. So this begs the question, why is the share price not reflecting this growth? Again, we can look at the balance sheet, the financial health. Huge net cash balance on this company. So the cash and equivalents, 472 million, debt of 7.6 million. So that's about 465 million in net cash, or 9.50 per share in net cash. Most of the company's value is actually just in the cash balance, trading again at about $12. So, and it's a profitable company. So one would expect that it wouldn't be trading at, what is it now? Actually about 5 times earnings on a trailing price to earnings multiple, or, roughly around 1.5 times earnings on a cash out basis, enterprise value to trailing earnings. So what is the issue? Well, there's a few things happening with the company right now. One was a substantial reduction in the company's 2024 guidance and expected financial performance. So they put out 2024 guidance just a couple of months ago with the 2023 annual results. And they were expecting to see decent growth, revenue in the range of 860 to 880, up from 743. Some growth in adjusted EBITDA as well, at about 180 million compared to 169 in the previous year. But only a few months later, they've had to make a substantial adjustment to that EBITDA. So they're now expecting to see revenue of only about 600 million, which would be a 19% decline, and a huge decline in adjusted EBITDA, 53% decline compared to the previous year, down to about $80 million. So this is a major issue for the company in terms of not just whether or not profitability is going to be sustained, but also investor confidence as well. There's a few other things that I think are dragging on the valuation. One is they're actually a foreign issuer. They're based in Israel. So that in and of itself is going to result in a discount. We've seen this before where there's quite a few Israeli-based companies that have a good, strong track record of growth, profitability, but they can never quite get that discount. Foreign issuers do have different guidelines in terms of disclosure. They actually don't release a 10Q or 10K report like a domestic US company would. They release what's called a 20F. So less disclosure guidelines. Now, a lot of these foreign issuers do disclose above the minimum that is required, but still, it doesn't fit nicely in the basket of a US stock. So a lot of people, a lot of investors are a little averse. Probably a lot of funds are restricted from owning them. So there's certainly a discount there, and as well Israel, with all of the fighting that's going on there right now, that's another source of uncertainty. Beyond that, there's high dependence on Microsoft. Microsoft is the company's biggest customer, 34% of revenue last year. Now, 34%, that's pretty significant customer concentration. I've seen a lot worse, but one of the things that is been attributed to the adjustment to Perion's guidance for 2024 were some changes that Microsoft made to its Bing system. So certainly there's a lot of dependency there. Another thing that's not listed here as well is that many ad tech stocks overall in the small and mid cap space have not been performing well. Ad tech as an industry is expected to experience strong growth, but a lot of these companies are competing with names like Google or Meta, which are acquiring market share. So there's at least an investor perception there that this market share is being acquired at the expense of some of the smaller companies. Now, that may not be the case. Small to mid tech, ad tech companies really vary in terms of their scope. A lot of them don't compete directly with the big companies, but that is certainly an investor concern. So another thing that we want to know is what is the company going to do with its net cash? And there's a substantial net cash balance there. And we would expect the company to be aggressively buying back shares with that money, given where the share price is. I mean, one would think, why would you purchase another business when your company is trading at such a low valuation? So we have looked at what the company's plans are based on the conference call. They're saying that they're going to focus on continue to invest in technology. They're going to consider additional mergers and acquisitions this year. In their conference call, they mentioned that buybacks and dividends were not ruled out. They've recently announced a $50 million buyback. But the primary focus, they say, is on creating long-term value by growing as fast as possible and providing value for shareholders through market leadership, as opposed to through buyback. So I can understand the strategy because a buyback, although it is increasing the existing shareholders' ownership in the business, doesn't necessarily improve the operations of the business. And they already have a fairly tight capital structure, but they also need to show that they're going to be able to do something with this net cash. If they're not going to be able to invest aggressively in technology, something that's going to produce tangible benefits over, say, the next 12 to 18 months, then many will wonder what the net cash is doing there, just sitting and not really doing much for investors. So we love companies with net cash, but it's not helping investors if it's just sitting in a bank account. This is something that people need to be aware of. So just in terms of our take on Perion, well, they are the biggest asset right now that I see with them is that they're sitting on a colossal amount of net cash. Now, if we look at valuation, they're trading at a very attractive valuation, a stupidly attractive valuation relative to the trailing earnings. However, with the big decline, big reduction in guidance so far for this year, if we're looking forward, we can't rely on that valuation. So we don't really know for sure what the earnings are going to be in 2024. I'm guessing that a lot of those earnings are actually going to come from interest from their cash balance. Now, it's not a bad thing to bring in the cash flow, but you want to see that the operations, the continuing operations, are profitable and generating growth, because Perion is not a bank. So sitting there and making interest income off of their cash balance is not what investors are looking for. So this substantial reduction in guidance for 2024 is a concern. It does draw into question whether or not they're going to sustain profitability from continuing operations. But it also makes us question what's going on with the business in terms of, does management really have any idea what to expect in 2024? If you're reducing your guidance by a moderate amount, that's understandable. But if you're dropping your revenue guidance by 19%, you're dropping your adjusted EBITDA guidance by over 50%, that is really an indication that there are uncertainties that not even management is able to get their head around right now. So how are investors supposed to? Our take right now is to be cautious. Yes, if you look at this from a net cash, from a fundamentals basis, there are a lot of great arguments to say this company is extremely cheap, but we wouldn't necessarily rush into any positions. We think it's still high risk. Although the net cash is attractive, they need to find a plan and actually execute on a plan to deploy it. So for now, we just continue to monitor the company. And we have actually spoken with management in the past. Last year at the Roth conference, we had an in-person meeting. We may reach out to them again, But we would also like to see how things trend over the next couple of quarters, because that that share price graph looks really ugly right now.
Yeah, and I mean, it looks like, and that essentially the reason they had the decline, obviously, it was attributed to changes in advertising pricing and mechanisms implemented by Microsoft Bing and its search distribution marketplace. So, you know, if just a change by Microsoft, and they say the relationship's still good, but if it just a change can amount to that much of a decrease in profitability, decrease in revenues, you know, how much control does this company have over its business? Really, clearly, not a ton of control in terms of its relationship with Microsoft at that point, because one change by Microsoft impacted them significantly. So,
Yeah, and I
it's
mean, the
it's a
dependency is
risk in the company.
obviously a major risk, and you don't know
Yeah,
what Microsoft is going to do in terms of changing
yeah.
their system. So maybe this is just the beginning of it.
And when you talk about customer concentration risk, this is kind of a case in point where, this is their major customer, and that change that they had no control over and likely didn't see coming affects the business massively right away, from point one. So that's the risk when you have an existing customer that is um, that large part of your business.